Perfect. Awesome. Well, really appreciate everyone's time, taking time out of your busy day. We're really excited for today's presentation. My name's Ryan Day, focused on business development here at Calvert Home Mortgage. Been with the company for about 2 years now, and really excited to just share our insights of what we've compiled over the past week or so with what's been going on in the market, some of the insights internally that we're able to share with yourself in order to just help increase financial literacy of real estate investors and just share our learnings with the audience. I'll let Rob take it over from here and introduce himself.
Thank you, Ryan. Thanks for everybody on the call. It's awesome to see some familiar faces. I'm looking through here at the name list, and a lot of people that we know. So great to be connected with you guys. My name is Rob. I'm one of the senior underwriters at Calvert. I've been with the company for, call it, 4 years now. And yeah, and let's go into the agenda. What we are going to talk about today. Quick overview of where we're seeing deals. What we mean by a deal is an opportunity to buy a distressed property that's currently undervalued due to its condition, make strategic improvements, create value, to sell or redeem on the equity by way of refinance. We're going to go through some tips to maximize profits. We're going to go over some market insights and updates. So Kai, I think that's going to hit on some of the questions that you had. And then we're going to do a quick product review, just refresh you guys of our rates and let you guys know how we are looking to support you and your clients right now. A little bit about Calvert, probably repeat material for everybody on the call, so I'm going to go quickly. Started off as a brokerage in 1975, became a MIC in 1982, and our focus is on short-term lending opportunities with strong exit strategies. And it is our mission to be trusted advisors, providing an effortless experience for the personal and financial success of others. Our mission statement could be translated as, we do not fund deals unless we believe in them. Unless we're going to be helping somebody out and improving the situation, we do not wish to participate in it. And with the market showing some signs of improving and stabilizing, we are expanding our loan to value. So throughout the course of this quantitative tightening cycle, we were noticing downward pressure on real estate and values. Because of that, we limited our loan to value in many areas to 70. So we're back up to 75 now. In the Windsor market, we are at 70. Any urban area though, pending review of the property and the borrower, we are back up to 75. And we're excited about that because we understand that the ability to lever more will create more lending opportunities for us to support you guys. So wanted to communicate that. Wonderful. Where are we seeing deals? Calgary and Edmonton continue to be strong. Calgary hasn't seen the slight price, some downward pressure in Edmonton. I think there's been a little bit there. Calgary has been pretty stable. But basically, guys, there are deals in Ottawa, the GTA, small towns with more than 10,000 people. You guys can read all those cities, so I'm not going to go through that. But the two things that are most strongly correlated with property values are population growth and population size. So this is why lenders and investors favor those areas. We have more people consuming real estate because it is a normal good, meaning that the more people make and the more people there are, the more that good is going to be consumed. And that is the area that we want to lend and focus in. So sometimes we'll have investors and say, hey, I have this awesome rural opportunity. We're 30 minutes outside the city limits. Maybe there's a Tim Hortons, maybe there's a stop sign. There's a really good chance that population hasn't changed in the last 30 years. Probably not the best opportunity. Let's focus on the areas which properties are transacting, and let's focus on the price points where the majority of the real estate is transacting at. So urban areas, growing populations, big populations. Let's play in the entry to mid-level markets. And if you check out our economic report, it'll actually show you what that price point is in every single one of these regions. So when you're working with your investor clients, you can see days on market. You can get a sense for what the HPI is doing for those, what the benchmark price is doing for those asset classes, and what is the price point for the asset class they should be focusing on, with a bunch of other information as well. Okay, let's talk about some quick market updates now. We keep track of all this stuff. Again, it's on our economic report, but a quick snapshot of what we're seeing. Inflation is going down, going down year over year. I was listening to a video last night with Dr. Benjamin Tal. He's the chief economist for CIBC. He's one of my favorite commentators out there. And he actually said that the portion of interest allocated towards your mortgage payment is considered rent, because it is rent on money, and it makes up a very large portion of the CPI box. So if you actually remove the increased cost of borrowing from the inflation equation, we're at, and if you look at the monthly rate of inflation, we're actually at 2% annualized. So while we're down, the inflation data is coming out, we're seeing it's going down. When the cost of borrowing could still be propping this up artificially, is the conclusion that Tal was trying to make. And when I look at the data, I agree with that conclusion. So inflation's going in the right direction. And we have some, the reason why the Bank of Canada increases rates is for people to buy less things, to balance supply and demand. We're seeing that balance start to be restored, and it could actually be a little bit rosier than what the data is telling us, because of the large portion that interest payments for housing makes up in the basket. And because of that too, we're starting to see some confidence restore on the outlook index. So the Bloomberg Nanos confidence index, how do people feel about real estate? Will it hold its value? Are people viewing it as a viable investment again? Are they thinking about purchasing real estate soon? Do they think that it can meet their investment objectives? And we're seeing that start to tick back up again too. So inflation down, confidence going back up. These are some positive things. It's been a really tricky period with QT that nobody expected. I signed up for a variable rate mortgage last January. Big mistake. But it looks like, we're heading into a time that's going to be a little bit more stable. And when I say stable real estate market, what that means is growth that is supported through economic fundamentals, and slower and steadier growth, less peaks and valleys, less ebbs and flows, a little bit less accelerated. We're hopefully going towards slow upticks, not these peaks and valleys that we've seen the last few years, thanks to COVID, deeply negative rates, and now 425 basis points and bond rates just going up, of course, as well. Population change, we talked about this too. Alberta, big increase in net migration, population change in Ontario. So some of the things that we're looking at here, Alberta is trying to recruit other people from our great country. Alberta is affordable. Our job market is strong. We have lots of things to offer to young families, great lifestyle at an affordable, basically you can buy more house and live a very good life in Alberta. So we're seeing some changes there. And then Ontario, when people immigrate to Canada, you're going to hear of, MTV, Montreal, Toronto, Vancouver. A very high percentage of all new immigrants land in one of those three cities, and they don't branch out there for a while most of the time. So a lot of the population growth is attributed to immigration as well in Ontario. But when new Canadians come, they're looking at MTV there as well. So population growth. We do, as a country, have very aggressive immigration targets. Whether or not we have the ability to process them is another thing. But again, going back a few slides when we talked about population growth, population size, Canada needs to immigrate a lot of people because we do not have a reproductive birth rate. So again, these are things that bode well for real estate because there are going to be more consumers in the market as a result. This is a slide that I found to be pretty interesting. This is just Alberta specific to give you some of an idea of the other things that we're considering too. Housing completions versus new households. This looks at, oh, and my watch went off. This looks at estimating how many households we're going to need versus how many are going to be built, considering anticipated population change, aging populations, and housing starts. And one of the things that, another trend that we continue to identify is that Canada remains undersupplied in terms of residential real estate. Looking at the G7, we actually have the least amount of housing units per capita in the G7. And then we look at what's happening here with a growing population and our immigration targets, and the fact that not a lot of people are doing construction right now because in the last year with the rising cost of capital, materials have gone up, your carrying costs have gone up. It's trickier to get development approvals at the municipal level. All of these things are saying developers are pushing developers to the side because right now the numbers in their models just aren't working. So after all of that verbal talking on my end, what is the conclusion of this? We remain undersupplied. There's going to be upward and we remain deeply undersupplied for residential real estate. So our long-term outlook is positive once we get through this cycle. And we're excited about that, as should every real estate professional be as well. House price indices is basically an equation where they take what they believe to be the average house in your composite, which is everything, and then they'll break it down for single family, detached, semi-detached, and apartment style condos and row townhomes, and then sometimes they'll even break it down into neighborhoods. This isn't the average as to what's happening per month because transactions could skew that. It's a mathematical equation for what they view to be the average house. So pre-pandemic, we saw that it was pretty flat. Then it spiked because we saw that pent-up demand and deeply negative rate territory with all the cheap capital. Of course, that drove up prices. Everybody on this call is aware of what was happening. You were probably all working 20-hour days finding financing solutions for your clients. Then we saw that correction come off. But the nice thing now is that we're seeing 2 to 3 months, depending on the market that you're looking at, with prices starting to go back up. So that's good. The market is adjusting to the new normal of the cost of capital. People are out there buying. There's not a lot of inventory though. And part of that could be because sellers are withholding inventory because they still want to see a little bit more stability in the market before they can accept that they could accept the price that the market would give them today. But anecdotally, I feel as well that we still have a lot of people who locked into cheap fixed rates in the last 2 to 3 years. Their mortgage rate probably starts with a 2, maybe a low 3, maybe even a high 1.9. I've seen some fixed in theirs as well. So when those people probably aren't selling and buying again, but when that mortgage cycle works its way through, again, this is just a theory that I have, we're going to start to see more people come off the sidelines for that reason when they are no longer benefiting from borrowing at a rate much lower than that of current market. Some other things that we look at and that are in our economic report. Insolvencies grew 33% year over year. That is the highest percentage since 2009. Go figure, similar economic event. Credit card loans started to spike in 22. If you look at these charts, insolvencies went down in COVID because of all the relief measures that were put into place. A lot of payment forgiveness, a lot of capitalizing payments. Creditors were doing everything that they could to maintain the health. So those top two those top two graphs, we're seeing that all the forgiveness relief programs resulted in very low delinquencies. I was chatting with trustees. They thought that COVID would make them busy. No, it almost put a lot of them out of business. And then because now money is becoming more expensive again, we're starting to see delinquencies on the rise again because Canadians in general are very levered. We consume a lot of debt. And if we look at the delinquency rates for the type of credit cards and automobiles remain high. Mortgages still remain somewhat low. Reason being, when your bill comes in, you're probably paying your mortgage first because that's the most important thing. You can do without paying your credit card or, hopefully not, but your automobile before you're not going to pay for the roof over your head. So mortgage arrears remain low. The other thing I would comment on about why mortgage arrears remain low is that a lot of the banks are, I don't want to say negatively amortizing, but they're doing a lot of things to maintain the health of their books. So extending amortizations, keeping payments the same, but capitalizing the outstanding the interest amount that's not sufficient to cover the payment and, adding that onto the principal. So basically extending the amortization through that. So mortgage lenders and banks have been pretty creative in keeping their book healthy to prevent the arrears from going up. Automobile and credit card loans do not have those same solutions affordable to them, and they're paid in lower priority by consumers as well. Okay, that concludes my quick market update. I'm going to pass it over to Ryan, and he is going to give the audience some tips on maximizing profits. And we'll keep it going from there. We got some stuff booked for you guys after that. So Brian, the floor is yours.
Perfect. Thanks, Maeve. So we compiled a list of top tips that we see a lot of our top clients execute in the marketplace. So we jumped on quite a few phone calls with our top accounts and just understand what practices, what measures and systems that they have placed in order to be successful. So the first one that we have mentioned here is that in your offer to purchase or purchase agreement, we typically see them including at least minimum one walkthrough, typically around 2, sometimes even 3 walkthroughs in their agreements of purchase. And what they're doing there is they're walking it with their contractor. They're getting a very detailed renovation summary, ordering the products beforehand, all of their materials for their renovations, and ensuring that come closing day, they have all of their materials ideally before possession day, just because obviously when it comes to alternative mortgages, your cost of capital is significantly higher as opposed to a traditional lender. So they try to maximize as much time as possible getting prepared for their flip and ensuring they're set up for success by including multiple walkthroughs within their purchase agreement to ensure that come closing day, they're set up for success. Number 2, they leverage their cheapest debt first. So a lot of these individuals are working with joint venture partners, or they have lines of credit, and they try and secure their cheapest capital first before they obviously, in a worst case scenario, need to maximize or leverage credit card debts. In a worst case scenario, I know there's a phenomenal Home Depot credit card as well too, where you don't need to pay interest for the first 60 days. So just leveraging obviously all of their different options for debt and using that in a way that obviously they're capitalizing on the cheapest debt first, maxing that out before they go to other sources. Number 3, they work with investor-focused industry professionals. So what we see common is, say if they're working for a realtor and their investment strategy is Airbnb, they're typically working with a realtor who individually, personally owns Airbnbs as well. They're investing in multifamily real estate. Typically, they have a team focus on either brokering multifamily real estate or working with investor-focused multifamily mortgage brokers as well too. So just ensuring that your power team is all aligned with your investment strategy, to just ensuring that you're set up for success. Number 2 is they definitely have detailed processes and systems in place for managing and ensuring that projects get done on time. Quite a few of our investors will walk properties minimum once a week to hold their tradespeople accountable. So this is just an example of what individuals do. So typically, say, for example, they host a walkthrough every Friday at 9 a.m. with their tradesperson to just understand from the previous week that all of the work is completed on time. There was no ambiguity with instructions and understanding the work that's going to be completed in the following week, and just be very specific with understanding the following week's scope of work. So they typically obviously have a contractor schedule for what's going to be done in week 2, 4, 6, 8, 10, 12, and so on and so forth, depending on the scope of the renovation. They really do not walk rush throughs, and they ensure to be extremely diligent and uncovering if there is any poor tradesmanship or poor work completed, that they're able to get on top of it ahead of time. If they are doing walkthroughs and they aren't in the specific city that they're investing in, so if say I'm in Calgary and I buy a property in Cornwall, that they do all this typically through FaceTime. They're either uploading photos to a Dropbox, to just be very crystal clear on holding everyone accountable for the work that's going to be completed on time. So that's something that we see a lot of our investors do to be ensure that projects get done on time and on budget. If they are looking for creating or working with a new contractor, they typically get multiple quotes. Within those quotes, they're ensuring that the exact same scope of work is going to be included, and understanding what the contractors are charging in terms of an hourly basis for their labor, and then also breaking it down by the materials as well too, just so they have an apples to apples comparison whenever there's any ambiguity with the scope of the work. Obviously that could skew the price of the tradesperson's quote. So typically they get minimum 5 quotes. The more the better, just to understand the fair market value of the work that's going to be completed. And then third, they are very clear on their payment schedule and future advancement dates. So typically, depending on the contractor or tradesperson, put 25% down. They understand, once the foundation's in, they're going to advance another 30%. Once framing's up, kitchen's up, and installed, and all the cabinets are up, they advance X amount. So they're just very clear on payment schedules and when future advancement dates are going to be completed in a timely manner, and then obviously ensuring that you pay all of your tradespeople on time when it's in the obviously the contract that you sign. So this is a report that was done from the Appraisal Institute of Canada that we thought would be really helpful. For those interested, we can definitely send it out after this call, but it was pretty much a report done from the Appraisal Institute of Canada, and they summarize what the top 5 renovations are with the highest return on investments. Obviously, here in Canada, people put a lot of value in kitchens and bathrooms. Typically what we see on a daily basis is, very similar renovations. Typically it's luxury vinyl plank flooring, open concepts, off grayish, whitish paints, white baseboards, very clean and aesthetically pleasing look. It's typically what we see on a daily basis. Number 3 for ROI is just ensuring that you're repainting interior and exterior. Obviously that can add a lot of curb appeal, and something that is quite obviously quite cheap relative to other scope of work that can be completed within the renovation. That can have a significant increase on just uplifting the feel and vibe of the whole house. Switching over here to the right hand side, top 5 renovations that maintain worth. So this is extending the economic life of the property. So replacing the roof, typically the big ticket item, the big ticket items completing in a house. So HVAC, windows, doors. I'm still blown away by how much it costs to install new windows. I'm looking to get that done on one of my properties right now, and quite exorbitant the cost. And then obviously updating electrical and repairing definitely 100% structural defects. Looks like we got a few questions in the chat here. Are there any rules of thumb for ratio, material costs or labor costs? Has that changed as material costs have increased? Great question, Brian. Off the top of my head, I don't have any rules of thumb for ratios. I could definitely get back to you on that though, speak with a few clients and understand if they have any ratios that they use internally. Oh, it looks like Rob Rob answered that after I scroll down. So thank you very much for doing that, Rob. Thought we'd open it up to the floor. If anyone else has any good tips for maximizing profits or from what you see on a daily basis to help real estate investors or other individuals on this call, we always love to share key insights just to help help other individuals. So if anyone has any other top tips for flips, managing tradespeople, deal sourcing, anything along those lines, we'll open it up for just a moment here. If not, it is all good. If anything comes up, feel free to share it with us and we can blast it out to everyone on the call. I know this was on our previous presentation, but we typically find that the number one issue with finding a deal is obviously, or sorry, with real estate investing is finding a deal. So these are wholesalers that we see a decent amount of deals from on a daily basis. We'll be sending this out to everyone on the call after this recording, but there's hyperlinks in here as well too to sign up for these wholesalers buyers list. For those of you who aren't aware, wholesalers are individuals who will purchase properties directly through sellers off market, so it's not on the MLS, and then they will send out marketing material with including property details, property photos, their assignment price, suggested renovations, and the closing dates, and then they assign that contract to an individual who is interested in purchasing it off the wholesaler. So for those of you who aren't aware, we're going to do a quick product update. If you are aware of our products that we currently offer, no harm and no foul with staying on and just getting a little refresher, but we will be going through our lending solutions for each of the provinces that we currently lend in. So in Alberta and Ontario, we're most known for our flip or BRRRR financing, which stands for buy, renovate, rent, refinance. In Alberta, the minimum that we need down is $10,000. The minimum that we need down in Ontario is $20,000. So we're able to offer clients to get into flip deals by removing the barrier of having typically 20-25% for a down payment. So reducing the cost of capital for individuals to get in and do a flip or implement the BRRRR strategy if they're looking to keep it as a cash flowing rental property. Also in Alberta and Ontario, we offer short-term bridge loans or in-term purchases. One thing to note in these provinces as well too, if you have any clients that are purchasing a pre-construction detached home or detached condo, we lend on the as-is value, not what the client purchased for. So say if they bought a new construction home and they purchased it for 600 grand, 3 years have gone by and it's now worth 800 grand. We would lend on the $800,000 as is value today, not the $600,000 value that they purchased it for in 3 years in that example. So able to get in with lower money out of their pocket in order to help your clients close on time, or if you're an individual and you're personally closing on pre-construction home, then you don't have to put as much money down in order to free up capital for other initiatives that you have on. In Alberta, we do some debt consolidation loans, equity takeout, and first and second mortgages as well too. So I'm sure everyone's very curious on our rates and fees for the two provinces. So this is for our flip and BRRRR financing. All of our mortgages for the flip and BRRRR are typically drawn up in 6-month intervals. I know that the rates can be a little bit hard to digest, especially with the lower down payment option. One thing to note is that these are fully open loans. So if you're in and out in 1 month, that 17.99% is never typically actualized unless you're doing a massive renovation where you're actually in the loan for 12 months. A more accurate depiction of these interest rates is dividing the annual rate by 12 to get a monthly rate, and then multiplying it by the number of months that you expect to be in the loan for. One thing whenever you are looking at private loans is really understanding the terms. I know if a lender has a really low interest rate, you really need to keep an eye on the other fees, or if they have a prepayment penalty, that's obviously something to take into consideration. If you think it'll be a quick flip where you're in and out in under 3 months, and you're stuck in the mortgage for minimum 6 months or minimum 3 months, then it's just something to take into consideration when exploring all options for your mortgages for these types of short-term loans. Our lender fees for these mortgage products are a minimum lender fee of $2,000 if the mortgage is under $100,000 or less. And our commitment fees range depending on the province from 1.5% to 3%. And for whenever you're working with wholesalers, we found that it is common practice for lenders to lend on the value that the wholesaler got the property under contract for. So say if a wholesaler gets a property under contract for 300 grand, they have a $20,000 assignment fee. Calvert would consider 320 the purchase price, whereas other lenders would consider the $300,000 the purchase price. So you or your client, if you're a mortgage broker, would need to come up with the down payment as well as the $20,000 wholesale fee that the wholesalers charge. Just going to quickly check the chat here. I see Rob Maver has been able to.
Ryan, I'll have the stuff in the chat. And then
Okay.
when we open it up, we can do that together. But you just keep going through what you're doing until we open it up, and I'll handle everything in the chat until then.
Perfect. Sounds great. So I know there's a whole bunch of different private lenders out there, hundreds, if not thousands, if you're considering the individual private lenders. This is what really makes us unique. So we are able to offer a commitment letter within 24 business hours for those very time sensitive deals. How we're able to offer that is, number one, we hire internal appraisers. So we currently have 3 right now who complete valuations for individuals who are looking to flip, BRRRR, or do interim purchases or equity takeouts. So they would value the property as is or as complete if you're flipping the property using the direct comparison approach. And those are done typically within 24 business hours, so completed in a very timely response. I know when things were super hot a year or two ago in COVID, it was really hard to get an appraisal in order to value a property or to provide you with an appraisal for a different lender. With us, they're completely free, so you save around, depending on the location and the property, around $300 to $500, depending on your city. So that's one cost that you don't need to worry about. With our valuations, once we have those back as well too, we stress test and underwrite the profitability of our clients, and we will only provide a mortgage if we see you, if you're the flipper or the real estate investor, making money. If we see that profit's really slim, we're going to come back and challenge you in order to just understand, is this the best use of your time? Is this the best use of your capital? And provide you our candid feedback and opinion from what we see on a daily basis of reviewing approximately 60 to 80 deals on a weekly basis, and just put you in touch with other wholesalers, real estate investors, in order to ensure that you're getting the best return on investment for your capital. Number 4, we don't have voicemails. We obviously do, but if you call our main line, there's always going to be an underwriter or an underwriter success associate available to take your call, especially if it's a time sensitive deal. We really understand and appreciate that typically time is of the essence whenever you have a property under contract that's under market value. Typically time is always of the essence, so we always pride ourselves on being available in order to provide you with a timely response, and let you know and update you if we're able to fund the deal or not. Number 5 here is we prepare all of our legal documentation, so this significantly helps the turnaround time. in being able to close a property on time. It significantly reduces the work that the lawyers have to do internally at their office. In Alberta, we are able to use one lawyer, so we just instruct the client's lawyer. In Ontario, it's a little bit of a different story. So we do have our own lawyer that the client pays for. So there are two sets of legal fees in Ontario and one set of legal fees in Alberta. We also do have options on all of our mortgages for a no renewal fee option for clients who are in good standing, which specifically means they're paying their mortgage on time. They are, and they're just communicating with us as well too. One other thing to note is if you as in a mortgage broker, you as in a client have other properties with equity, we are able to get extremely creative by providing a blanket mortgage solution. So we essentially take a look at the other properties that you have with equity. In some instances, take them up to 75% loan to value, depending on the property type and the location. And we're able to either advance you funds or reduce our interest rate for properties that you're looking to flip or purchase. So if you have other assets that you're willing to put up as security, we are able to get quite creative with how we structure our mortgages in order to meet the objectives of what you or your clients are looking to do. And then I know it's not mentioned here, but obviously having a low money down option reduce the cost of capital and barriers to entry. So with a lower money down payment, you are able to obviously purchase more properties. So say if you had 200 grand, for example, and a lender requires 20% down, depending on the location, you typically only be able to capitalize on one or two opportunities, depending on the scope of the renovation. We have several clients, once the relationship has been built and they have a track record with us, have the option to do multiple flips at once. So leverage minimum $20,000 down if they're in Ontario, or 10,000 down in Alberta. And they're able to capitalize on more opportunity and stretching their capital further by capitalizing obviously on more opportunities. Obviously they'll pay a higher interest rate, but when we do run the numbers, instead of paying, 5-10 grand more in interest, they're able to make an additional $40,000 or $50,000 by putting less capital into the deal in terms of down payment and leverage their capital even further. So this is a really handy slide, just because it outlines the criteria of where we specifically lend. Whenever we get a new deal, typically the first or second question we're going to ask is either what's the address or where's the property located. So we are quite focused on location, just due to Rob's point. We're focused on major urban city centers where we see the most velocity and turn of purchases of new house. Whenever we get into the really rural areas, typically we find that it sits longer on the MLS. The demand for very rural houses isn't obviously as strong as major urban city centers. So we typically really focus on the higher populations, 100,000 and above. But a really quick and easy rule of thumb is if there's a population 10,000 above, we'll look to do the deal there. Here at Calvert, we don't have any minimum loan amounts. It's just something to take into the cost of borrowing. We do have minimum lender fees, which is $2,000. So if you're borrowing under $100,000, it's just something to take into your cost of borrowing if you do have a smaller mortgage amount. The most we will lend on one property though is 1.5 million. I know Rob touched on it earlier as well too. Highest velocity in terms of transactions on the lower end to mid-market price range. Whenever we get to the higher end properties, those are obviously the most susceptible whenever there are downturns to larger decrease in valuations. So we really focus on the lower end to the mid price point range of properties in urban city centers for those specific reasons. We do notice that it is quite common in Ontario and in Alberta for individuals to lend or borrow in corporations in order to be tax efficient. So If an individual is looking to purchase a property and they just created a corporation last year, that's completely fine. Subject to due diligence, obviously, but the main thing that we're looking for there is that personally of all shareholders within the corporation do not owe tax, either personally or in the corporation. As long as that it meets that requirement, we can look to 100% lend and help clients purchase properties in a corporation. And last but not least, loan to value. Obviously, it's a huge consideration for individuals looking to purchase properties. So we go up to 85% loan to value on bridge deals and up to 75% loan to value on our other range of products, keeping in mind that we do take a look at the after repair value. So that's how we're able to offer a low money down solution, is because we're taking a look at the after repair value for individuals looking to flip or BRRRR. So this was a flip of the month that we sent out earlier in March. So we'd love to highlight and showcase the phenomenal work of individuals who implement flips. So this was a flip that was done obviously back in March. If you'd like to be featured on one of our flips, we'd love to collaborate. If you're a mortgage broker or a borrower, typically we do before and after. We do borrower interviews as well too. So if this is something that you're looking to focus on, we'd love to help you support and grow your brand and marketing. If you do have a project that obviously Calvert has funded, we always love sharing our insights, our clients' insights as well too. There's always so much to learn and understand in the realm of real estate investing. So feel free, reach out if this is something that that interests you. For all of the loans where a client is going to be renovating the property, we do require a renovation budget. The reason being is because, as mentioned before, we do take a look at the after repair value. So we have a phenomenal template that our team has drawn up. If you're working with a contractor, then having them fill out a contractor's quote as well too is something that's also applicable. But where we see the most success when clients submit these renovation budgets is when they're extremely detailed. So the more detail that the client is able to provide, or yourself, the better. And it essentially helps with two reasons. Is number one, when you're very clear on the scope of the renovation, our appraisers are able to pull comps significantly easier, just because there's no ambiguity with the type of work that's going to be completed. So if you put down kitchen $10,000, it's just not clear on what's going to be included in that $10,000 renovation. But then also number two, whenever you have and provide a very detailed renovation, it significantly helps with the turnaround time, just because there's no ambiguity. So we're able to provide you with a quicker valuation in most instances, just because there's phenomenal detail in the renovation summary. With us, we'd like to think that submitting a deal is quite effortless. So we have an application that we use that I'm happy to share with everyone on the call. We'll be pulling credit for those who are looking to borrow from us, just to understand what credit looks like. Notice of assessments, we're not so much looking for income there. What we're primarily looking for is that you're all up to date on taxes. We have quite a few clients who are business for self, and on paper, to be tax efficient, they show that they make 30, 40, 50 grand in order to be tax efficient. That's completely okay with us, as long as you show us that you have the capital for down payment, renovations, carrying costs, operating costs, and closing costs, so enough to service the project from start to finish. That's primarily what we're looking at. Corporate borrowers as well too. I know I touched on that. The documents down below are what's required if you're looking to borrow in a corporation. Mainly just looking for articles of incorporation and year-end financials, ensuring that the corp does not owe any taxes. And last but not least, just a summary of what your plans are for the project, your experience, where you're sourcing the funds from. Typically, we like to just jump on a 5-minute call, understand all of the above through a quick phone call, in order to set you up for success whenever you are looking to do if you are looking to do a flip with us. One other thing to note is we are able to pre-approve clients. Pre-approval includes the top 4 agenda items here. So, or sorry, the top 3 plus proof of funds. So application, credit, notice of assessments. Once we have all of that information, we only need that once a year. So going forward, it's just documentation related to the project that you're looking to execute on. So it significantly reduces the turnaround time in order to provide you with a quicker response if you do get pre-approved with us. There's no cost, no fee in order to get pre-approved. So it's literally just the time of putting in 10 minutes and submitting your documents to us. Perfect. Perfect. So these are the underwriters on the team and their contact details below. We highly encourage everyone on the call to follow us on Instagram. We really pride ourselves on focusing on educational content in order to help real estate investors and mortgage brokers. So if you're ever looking to collaborate on content, feel free to reach out. We'd love to help and serve in any way possible. If anyone has any questions, comments, feedback, any tips on what you'd like to hear on future presentations and webinars, we will open up the floor. Not too sure if you had anything else to add as well too, Rob.
No, I think you did an awesome job covering the material. You know, a big thing that we're trying to do right now is just give as much information to the real estate investor community that we can and the broker communities that we can. And I know that we remain deeply committed to doing whatever we can to provide service for our clients. So even if it's not just real estate investors, in the private and alternative lending space, what opportunities are you having a tough time placing? What can alternative lenders do better in terms of service, in terms of product? What are some pain points? So outside of real estate investor stuff too, we're always open to this feedback and understanding how we can help you guys more. So if any of that feedback comes up in terms of product, service, criteria, please bring that up to me so we can make sure that our lending products are serving you guys and therefore serving the market the best that they can as well as a result.
Perfect. Looks like you did a great job answering the questions in the chat there.
Yep, I think we got all of those covered. I love what Lynn said about bringing on a tax expert. That is one of the things that we are going to be working on to right now. It's their Super Bowl season, their Grey Cup, their Stanley Cup season, their Masters, because of course it's tax time. Once we move away from tax time and the accountants are less busy, we will be looking to do a webinar on that topic. So like bringing in on a holdco, how to reduce your taxable income, how to take advantage of things like writing off interest expenses and capital cost allowance and some other things. There's so many great ways that investors can really maximize the tax benefit of real estate, because that's why so many people use real estate and real estate assets as an investment tool, as they do have lots of benefits, and we'd love to explore the tax ones. Further to that, about what I said about doing more and providing more content, we are also thinking about bringing a lawyer on to do a webinar, maybe a contractor, maybe some other flippers, maybe some brokers if they want to collaborate on something. So again, ideas to do more there, anything, we're open to all of it. Ooh,
Perfect.
Tangier, good question. Bringing the heat, I like it. Using general contractors or managing subs. Everybody's business plan is different, unfortunately, which unfortunately makes my answer a little bit more generic. We've seen success with both. Some people run multiple properties and they have GCs managing a handful of them. Other people prefer to be hands-on. The biggest thing that I would say is that those who have the most success are the ones that stick to their plan. They have a firm command of what their costs are, and they stick within them. So as long as they account for it within their pro forma, within their flip analyzer, within their models, and the costs don't deviate too much, or if they do, they have a budgeted contingency, those are the people that we're seeing being the most successful. Because some of the people that I work with are like me, useless when it comes to doing a flip, probably could only repair a light bulb. I have a water faucet that's been sitting at the top of my stairs for 2 years now. My wife is super not pleased with me. And I also work with people that really struggle with completing paperwork, but they are dominant on the tools and do all the work themselves. So, you know, everybody's different, and we're happy to work with all of them.
Perfect. Well, we can give.
Any other questions? Easy, hard, play to your strengths. Yes. Know your talents. I like it. Thank you, Stephanie.
Thank you, Robert and Ryan. Great presentation.
Thanks, Kai. Appreciate you taking the time to join us today.
No problem. Thank you for approving a deal for me.
Oh,
I'm
we
just-
got many more on the way, Kai.
Oh yeah, for sure.
May need you myself on a new build. Wonderful. We
Okay.
do lend on the market value of properties too. So this is one of my favorite types of products where we lend on the market value, not the purchase price. So the benefit is if you bought the property here and the value's gone up, well, you can sell it for the profit. Or if you have a strategy with your mortgage broker to close now with less cash in the deal and then refinance, you can keep more of that initial down payment in your pocket too. So yes, we love Burlington, would be happy to look at